Ask the Wiz Wealth Institute Tier 1 and Tier 2 classes in session this Saturday, December the 2nd, 2017. Now, family members and listeners alike, a certain portion of your portfolio should indeed be in speculative positions, but these positions must be well chosen. And you must know the appropriate strategy to allow you to extract the maximum amount of profit from these speculative positions in the least amount of time, because they are indeed speculative, which means they can move against you very quickly at any given time. Now, there are positions in the marketplace that pay exorbitantly high dividend payouts. Now, as a rule of thumb, when a company pays exorbitantly high dividend payouts and they're taking the dividend payment out of a large portion of their revenue and income, that's a sign for you to be weary, because a company at any given time can stop or reduce their dividend payout. When that happens, the underlying stock tends to move to the downside because people tend to sell off the stock. Traders and investors are fair weather friends. And when they buy dividends from a company that's paying dividends, they're on just for the ride, for the dividend that company is paying in many instances. Now, this is how you monetize that cleverly. You see, trading and investing, before all other things, is the monetization of human behavior. Listen to me closely. In order for you to get P.A.I.D, in order for you to receive money, somebody has to lose money. There's always two sides to a trade, a winner and a loser. We at the ASK THE WIZ Wealth Institute, we're blessed to most of the time be on the winning side. So, we have to think of intelligent and consistent ways to monetize the behavior of other traders and investors such that they are losers and we are winners. In trading and investing, everybody can't be winning. Everybody can't be making money, because if that was the case, the market couldn't sustain itself. Everybody would be selling the clothes, pulling money out of the market, and as a result of that, the market would stay consistently down. It would implode. So the uber wealthy, like I indicated to you earlier today, the Waltons families, they make their money off of the uninitiated, those that are not educated about how trading and investing in the capitalistic system truly works. And that's what we seek to do in the ASK THE WIZ Wealth Institute, bringing people out of the darkness and into the light pertaining to trading and investing. Now, when you see people, and the majority of traders and investors who buy dividend paying positions, they buy that position because it pays dividends. Now, the clever way to monetize that behavior, once again, trading and investing is nothing more than the monetization of human behavior, is to implement our ASK THE WIZ Wealth Institute dividend option trifecta effect strategy. Now, what that is this. Once again, think back to your psychology 101 days, okay? People will buy. People want to get in on something that they think is winning. When people look at a stock that's paying dividends, they think, oh, that's a winning situation because the company is paying them a dividend just for holding the stock. When a company sells off or decreases or stops that dividend, people are fickle. Traders and investors are fair weather friends. They move on to the next company that perhaps is paying a more stable dividend. Now, as that dividend increases, the amount, the percentage, people then get giddy. They start to forget to look at the fundamentals of a company. And a company knows that. So oftentimes when the fundamentals of a company begin to wane, they'll increase the dividend to cause more people to buy the stock, because the underlying fundamentals of the stock are getting more and more leery. They're getting more and more unstable. So to camouflage that, the company goes into the marketplace and says, look, we'll pay you to buy our stock. Now, a company that is paying a 10% dividend on a company stock that's trading at $50 per share, okay? And that dividend is paid cumulatively annually, most oftentimes per quarter. Sometimes, we do have a list of companies that pay monthly, but most companies pay per quarter. A company is doing a bait and switch. So they're putting a teaser, something shiny out there for the uninitiated trader and investor. That something shiny is the dividend. People bite at that. and they go and buy, and the only way you can get the dividend is what? You got to buy the stock. See the switch? See the bait and switch? So I offer you a dividend. You are blinded by that something shiny. You don't look at the fundamentals of my company, and you buy my stock. So I give you a dividend, which is a pale percentage of my overall stock price. Who wins in that situation? I do. Now keep in mind, I can stop this dividend payment at any time. I can reduce this dividend payment at any time. Now, the way you monetize both the company that is offering something shiny and the knuckleheads who are going and buying something shiny is utilizing our ASK THE WIZ Wealth Institute dividend option trifecta effect strategy. Now listen to me. Each company that's publicly traded has what is called a shareholder of record date. Write that down. Shareholder of record date. Now the shareholder of record date is the date that a person must technically own the stock on the straight up stock buy to get the dividend payout. The second important date is the dividend payout date. That's when the company pays the dividend to those who have technically bought and owned the stock by the shareholder date. The third most important date for any company that pays a dividend is the earnings report date, the ER date. Because the stock will rise or fall based upon that earnings report. Now, our dividend option trifecta effect monetizes those three events. Shareholder record date, people will be clamoring to the company to buy the stock before that particular date. Therefore what? When a stock is being bought, the stock does what? It goes up. Therefore, call option, we get paid as the knuckleheads run up the stock, as they buy the stock before or on the shareholder record date so they can get the dividend. Bam! Check and mate. Second thing, many of the people who buy the dividend will sell, because they're fair weather friends, they will sell that same stock on and right after the dividend payout date. They're fair weather friends. When people sell in mass on a particular stock, a stock has to do what? Go down. Put option, check and mate, we get paid again. The third time we get paid is during the earnings report date, all of which is publicly recorded and it is accessible. You know the date before it occurs. Now on that ER date, we have a specific ASK THE WIZ Wealth Institute ER drill down to determine whether or not that earnings report is going to be positive or negative. Now, if that earnings report comes out and it is positive and the numbers are demonstrably higher than the market expectations, the stock will rise. Call option, check and mate. In the event the earnings report numbers are at or far below the market expectations upon release, the underlying stock will fall. Put option, check and mate. You just got paid 3 times across the dividend paying stock without buying the stock straight up. 99.9% of traders and investors think the only way you can get paid from a dividend stock is you gotta buy the stock. No. Those of us that know that the best way to get paid from dividend paying stocks is to monetize the human behavior from the herd, the retail traders and investors who will be trading on the stock because it pays a dividend. You should be wise. Stay out in front of the market and see now what others see eventually and get paid by the human behavior that is displayed in the markets.